Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.
So anyway, we compare these particular currencies, and again, we use the dollar index as kind of a general thumbnail against fixed income, against stocks or equities per se. We use indices. We don't break down and look at individual stocks. We look at commodities. Gold and oil is our primary look at commodities. Sometimes we'll look at the grains against the currencies. And we also compare the currencies against some economic fundamental data, and there's really a lot to be gleaned there. We saw a very interesting relationship between the trade data, for example, a very tight correlation between German trade data and the movement of the Turkish lira recently. You know, we stumbled upon that. Not that you're going to stumble upon something as obscure as that, but interestingly enough, you often find economic fundamental data that correlates very, very tightly with the currencies. A very good one for the Japanese yen on a long-term basis not only is the Nikkei in the Japanese yen, which we look at very often, but machine tool, change in machine tool orders in Japan versus the Japanese yen over a long-term basis has been an excellent correlation since around 2005, 2006. So there are things out there in the economic world that people just take as a data source, but we can actually use those really as in terms of evaluating the currencies. Just to give us some correlated look, and I think when you get into the economic fundamentals, you definitely see the tie between price action and fundamentals and currencies. But there's actually an economic tie is really the same thing you're looking at when you're comparing it against different fixed income classes or equity classes and commodity classes. In the background, there is some economic relationship, or there should be, and the stronger the relationship that you can define, the better it is. Why does this correlation or intermarket analysis work? It works primarily because currencies or money drives every one of these asset classes, and the ability to just start looking at these things together, it's a way to look at how money is flowing around the globe, what's hot and what's not. So it does work, and it has worked, and it's been a very tight correlation in the world from 2002, since the last dollar bear market started, and it's still fairly tight. We're starting to see a little breakdown in some of these correlations that we hadn't seen before, but the correlations in various time frames are still pretty tight. That may change, and I'll get to that in a later slide, but these correlations, if they make sense from the standpoint of if you can find some logic behind this, some economic logic behind this, the stronger the correlation. Now again, we have to be careful. In the short term, these correlations can break down. Longer term correlations that look tight can break down for weeks or months at a time. A good economic correlation that makes a lot of sense that people use, and sometimes they don't think of the economic correlation, is gold, and I think it's a very good example to use. Remember, gold is priced in dollars. The dollar is the world reserve currency. Gold has to maintain purchasing power against all real assets across the globe, against all borders. So therefore, if the U.S. dollar, the world reserve currency, falls in value, gold has to go up in order to maintain its global purchasing power. That is the role gold plays. So that's a direct economic relationship, and that's why you see, especially on the longer term basis, the further you step back, a direct correlation between gold and the dollar. The higher gold goes, usually the lower the dollar goes, and vice versa. Sometimes they do move together, but it's fairly infrequent. This correlation in gold and the dollar is something we watch every day, and we use it in various time frames for just some validation of some of our trades. Keep in mind, this is, as I think I said already, this is really some information that should support your trading decision. This shouldn't be your holy grail, meaning you shouldn't base all your trading off of, hey, this correlation looks like it makes sense, because the problem is we don't know who leads and who follows. Sometimes it appears we can make a decision on who's leading and who's following, but you have to be very, very careful there. Just use this as a general correlation, as another piece of the puzzle, kind of an arrow in your quiver of different tools. It's a very important one for us because, as Steve said, we use a lot of fundamental analysis, and this is kind of that link. Think of intermarket analysis as that link that kind of links your technical analysis to your fundamentals. It's kind of that gray area in between that links these two together, and that's the way we use it. So just be careful. That's not, as I said, it's not a holy grail, but it's worked very, very well in this market for currencies, and it could break down. Maybe I'll get to that point right now. It could break down because what we're seeing changing in the last bear market cycle in the U.S. dollar, we happen to think we're entering a major bull market cycle in the dollar, and I'll get to that in the last slide. But the reason this has worked so well during the last bear market is because we've seen so much credit-driven, liquidity-driven moves in a lot of the other asset classes. For example, the dollar coming down in the bear market from 2002 on to 2008 at bottom in March of 2008. It really has been the funding, really funded all global asset classes. The reason, and you can see it by the fact that there's a massive amount of U.S. dollar credit created. Those derivatives that everybody talks about is dollar-based credit being created that goes out into the world and funds other asset classes, risky asset classes, emerging market classes, stocks, bonds, whatever. That in and of itself drives growth, that drives oil prices, drives stock prices. So you've seen a very tight relationship with the dollar going down and the other major asset classes going up. We saw it very, very tight during the credit crunch. The dollar went up, the other asset classes went down, and we saw it happen again once the whole green shoots era again started and the globe started healing. The dollar down and the other asset classes up. Of late, that correlation is changing a bit. We've seen the stock market continue up and the dollar start to rally. So things are changing here, and I think part of the reason that they may change in 2010, these correlations may not be as tight, although I think still very useful from a position trading type of mentality. The reason they may not be as tight is because we've left that kind of, perfect storm of credit availability. We don't have that any longer. And we also have a situation in which the interest rates among the major central banks in the world are tending to normalizing together, so you don't have these giant liquidity-driven moves that move asset classes accordingly. So I think you're going to see some more fundamentals being used to evaluate these currencies going forward. So that's just an important consideration when you use these. If you use these correlations or use them in the future, just be careful. Obviously, the key point of using these correlations is identify the key themes out there. And we think of the key major market themes out there. The two are risk appetite and risk aversion. Risk appetite meaning credit is flowing outward to risky asset classes outside of the U.S. to fund other asset classes in the world. China is the poster child, money moving to China or other emerging markets to get access to higher growth, riskier areas, whether it's in emerging market bonds or stocks, those types of things. That's a risk appetite move, and it tends to hurt the dollar because the dollar is the global, I shouldn't say funding currency because that mixes with a carry trade. You have to keep in mind the dollar is a world reserve currency. When it replaced gold back in 1970, in the early 70s, I guess you could say, once it started floating, the dollar basically, through the current U.S. current account, is what funds global asset classes. It's why the U.S., as a world reserve owner of the world reserve currency, is seemingly locked into these chronic current account deficits, because the bigger the deficit, the more liquidity out around the globe. The improvement in the deficit, and I'll get to this, the less liquidity around the globe. So it makes sense when there's a big appetite for risk and money's moving offshore, increasing U.S. current account deficits, pumping up asset classes around the globe. It goes together, and you see that in the correlations.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.